Most people think buying gold is enough to protect their wealth, and that's exactly why they stay average. Because smart investors don't choose between gold and silver, they use both strategically. One metal is built for survival. And when you understand how they work together, you stop reacting to the economy and start positioning ahead of it. Here's the part most people never hear. During financial crises, one metal quietly preserves fortunes, while the other becomes the biggest percentage gainer in the entire commodities market. This isn't about stacking shiny coins. It's about thinking like central banks, billionaires, and smart money that prepares for both collapse and opportunity. Most investors grow up hearing one simple rule. If you want safety, buy gold. And while that sounds smart, it's only half the story. Gold has been marketed for decades as the ultimate safe haven. TV ads push it. Financial gurus repeat it. Even our grandparents trusted it. So naturally, retail investors put all their focus on gold and completely ignore silver, treating it like a cheaper, less important metal. They call silver the poor man's gold. But that label is not just wrong, it's dangerous. Smart investors see gold and silver as two completely different financial tools. Gold is stability, silver is performance. Gold moves slower, protects purchasing power, and acts like wealth insurance during crises. But silver lives in a much smaller market with massive industrial demand. That means when money flows into metals, silver doesn't just follow gold, it often outpaces it. Here's what most people don't understand. If you only hold gold, you're playing defense. If you only hold silver, you're taking on unnecessary risk. But when you hold both, you create balance. Protection on one side, growth potential on the other. The biggest myth isn't that gold is valuable. It's the belief that gold alone is enough, and that's the difference between average investors and smart money. Gold is not about getting rich. Gold is about staying rich. For over 5,000 years, gold has survived wars, empires, currency collapses, and financial crises, and it has never gone to zero. That's why central banks don't hold Bitcoin, stocks, or real estate in their reserves. They hold gold. Because gold has one job: protect purchasing power. When inflation rises, currencies weaken, or markets panic, gold becomes the asset investors run to. It doesn't move fast. It doesn't create massive percentage gains overnight. And that's exactly why it's valuable. Its stability is the feature, not the flaw. Gold is financial insurance. You don't buy insurance to make money, you buy it so a disaster doesn't wipe you out. Another key advantage is volatility. Compared to silver, gold moves more slowly and with less extreme swings. That makes it the foundation metal in a precious metals strategy. Smart investors use gold as the base layer of their portfolio, the part that protects wealth during uncertainty, currency devaluation, and systemic risk. Because when everything else becomes unpredictable, gold is the asset designed to hold its ground. If gold is the shield, silver is the accelerator. Silver sits in a much smaller market than gold, which means it takes far less money to move the price. When demand increases, silver doesn't climb slowly, it tends to surge. That's why in major bull runs, silver often delivers larger percentage gains than gold. But the real difference is demand. Gold is mostly a monetary metal. Silver is both monetary and industrial. It's used in solar panels, electric vehicles, medical technology, electronics, and energy infrastructure. As the world becomes more digital and more electrified, silver demand keeps expanding, and that creates long-term upward pressure on price. This is why many smart investors see silver as an undervalued asset relative to gold. Historically, when metals enter a strong bull phase, silver doesn't just follow gold, it outperforms it. Yes, it's more volatile, prices swing faster. But that volatility is exactly what creates opportunity. Gold preserves wealth, silver grows it. And when you combine stability with upside potential, you stop depending on a single outcome and start preparing for multiple market scenarios. This is where smart investors separate themselves from the crowd. The gold-silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. For example, if the ratio is 80 to 1, it means gold is worth 80 times more than silver. Historically, this ratio has moved in cycles. When the ratio gets very high, silver is considered undervalued relative to gold. When the ratio drops, silver has usually outperformed and closed the gap. Smart investors don't just buy metals, they watch this ratio and rotate between them. When silver is cheap compared to gold, they accumulate silver. When silver becomes expensive relative to gold, they shift back into gold to lock in gains and reduce risk. This strategy doesn't require predicting the economy, inflation, or interest rates. It's based on relative value between two real assets. And over time, that rotation can increase total metal holdings without adding new money. This is how experienced investors think. Gold for stability, silver for expansion, and the ratio as the roadmap that tells them when to rebalance. Different metals for different economic seasons. During financial crises, market crashes, banking fears, currency instability, gold becomes the primary safe haven. Investors move towards stability, and gold's lower volatility makes it the preferred store of value. This is when gold tends to hold its ground or rise while risk assets fall. Silver, on the other hand, often behaves differently in the early stages of a crisis. Because it has strong industrial demand, it can drop alongside the broader economy when manufacturing slows. That's why silver can look weaker than gold during panic phases. But here's the shift most people miss. When the crisis response begins, stimulus, money printing, economic recovery, silver usually accelerates faster. As liquidity returns and industrial demand picks up, silver transitions from lagging to outperforming. So the pattern is clear. Crisis phase gives gold leads. Recovery and bull phase gives silver surges. Holding both metals allows investors to stay protected during downturns and still participate in upside when growth returns. Gold gives you resilience. Silver gives you momentum. Owning both metals is only part of the strategy. The balance between them is what creates stability. Conservative investors often lean heavier toward gold, using it as the core wealth protection layer. A structure like 70% gold and 30% silver focuses on safety while still allowing some growth potential. A more balanced approach, around 60% gold and 40% silver, gives you protection during crises and meaningful upside during bull markets. This is one of the most commonly used long-term allocations. More aggressive investors sometimes move closer to a 50-50 split, especially when they believe silver is historically undervalued. That increases volatility. But it also increases potential returns when metals rally. The key is not chasing price, it's maintaining a ratio that matches your risk tolerance. Because the goal isn't to predict which metal will win next. The goal is to build a portfolio that performs in multiple economic environments without forcing you to time the market. Not all metal investments are the same. Physical gold and silver, coins and bars you can actually hold, provide direct ownership. There's no counterparty risk, no dependency on a financial institution, and no concern about market closures or liquidity freezes. This is the form of metal designed for true wealth protection. Paper metals, like ETFs and trading contracts, serve a different purpose. They offer convenience, fast buying and selling, and price exposure without the need for storage. But they are financial products, not physical assets, which means they carry system risk. Smart investors often use both. Physical metals for long-term security. Paper metals for short-term flexibility and trading. Because in a normal market, liquidity matters. But in a crisis, ownership matters more. If you don't hold it, you don't own it. Isn't just a slogan. It is a risk management principle that separates strategic investors from speculative ones. Average investors ask, should I buy gold or silver? Smart investors ask, how do I use both? Because the real strategy isn't picking a winner, it's building a system. Gold becomes the foundation. It protects purchasing power, reduces portfolio volatility, and acts as financial insurance when uncertainty rises. It's the metal designed to survive. Silver becomes the accelerator. It adds growth potential, benefits from industrial demand, and historically delivers stronger percentage gains during metal bull cycles. Together, they create balance. Stability on one side, opportunity on the other. This dual metal approach means you're not dependent on a single economic outcome. Whether the future brings inflation, recession, recovery, or currency pressure, your portfolio is positioned to respond. That's how central banks think. That's how long-term wealth is preserved. Don't think like a buyer chasing price. Think like an investor building resilience, with gold as the shield and silver as the engine. The biggest mistake investors make is treating gold and silver as competitors. In reality, they are partners. Gold is your financial defense system. It stands firm when currencies weaken, markets panic, and uncertainty rises. It's the metal that helps you sleep at night. Silver is your offensive tool. It captures momentum when economies recover, technology expands, and liquidity floods into hard assets. It's where percentage gains often happen. Separately, each metal solves only part of the problem. Together, they create a complete strategy: protection in downturns, growth in upswings, and flexibility across economic cycles. This isn't about predicting the next crash or the next rally, it's about preparing for both. Because smart investing isn't reacting to headlines. It's positioning before the shift happens. Hold gold to preserve what you've built. Hold silver to expand it. That's not speculation. That's strategy.